Hello. Now, inflation has been a top priority for central bankers and investors globally. Persistently high inflation prints have prompted central banks to be more hawkish. While the expectation was for inflation to moderate lower, this has been delayed by the Russian-Ukraine conflict and high commodity prices. Still, we expect inflation in the US to be coming down since supply-side shocks should fade and slow down price increase. Now, oil prices have risen by about 20% since the end of January, primarily due to the Russian-Ukraine conflict and the potential to diminish supplies in an already tight oil market just as demand is recovering globally. Our analysis shows that for a 10% increase in oil prices, we should expect a 1 to 1.5 percentage point impact on energy inflation. However, the good news is that higher prices do not show much of a pass-through to core service inflation. Now, new and used vehicles are the two categories within core goods that have seen a significant pickup in inflation due to ongoing supply chain woes. This is also easing. Now, the stickier part of inflation depends heavily on changes in shelter CPI, which accounts for roughly 1/3 of the headline CPI basket. However, our analysis suggests that the peak of shelter price increase has been reached. We see that the increase in rent has slowed down and house price increase has decelerated as well. And this could be brought by an increase in housing construction and higher mortgage rates cooling the market. Higher wages leading to stronger inflation should also ease as more workers are expected to return to the job market with the COVID situation in the US eases, household savings decline, and unemployment benefits return to the pre-pandemic level. For all the reasons we've covered just now, we think that US inflation should moderate lower throughout the course of 2022. This, alongside with moderating demand, should give the Federal Reserve enough reason to pursue a more gradual path of normalization. We see the Fed's policy to be less of a threat to risk assets, even though uncertainties from geopolitics could still be impacting on investment. Now, with this backdrop, we prefer equities to credits and government bonds. Within equities, we recommend a globally diversified allocation and a preference for value and cyclical sectors over growth and defensives. Arguably, commodities also warrant a place as an inflation hedge in multi-assets portfolio, with the demand-supply dynamics remaining favorable.